spread trading the indexes, trading the Russell versus the S&P, using micros for spreading, the importance of having skin in the game, using and trading the VIX. All this today and more on the Futures Radio Show podcast with Head of Research and Consulting at EQ Derivatives and Clinical Professor of Finance at Loyola, Russell Rhoads. Futures Radio Show is sponsored by CME Group. They are the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. For new show notifications, please subscribe to Futures Radio Show podcast on iTunes, YouTube, Google Podcasts, Spotify, or Stitcher. This show is also sponsored by Trading Technologies, RJO Futures, and FTSE Russell. The Russell 2000 is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 futures symbol RTY and Micro E-Mini Russell 2000 futures symbol M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com.
Professionally, I've been in charge of research and consulting for EQ Derivatives now, coming up on 6 months. Needless to say, everything in 2020, the time seems to fly very quickly. But I joined these guys after, and I knew them quite well ahead of time, but I had been at SIBO for almost a decade and finished up my time at SIBO in charge of the what they refer to as the Options Institute. They may be rebranding that right now. But I got to where I really enjoyed talking about the markets as opposed to being tied to the monitor from day to day. And that's kind of led me in a different direction because I was teaching more and doing more research on how to trade the things that were SIBO specific. I got interested in the academic area, and I'm actually very, very close to finishing up my PhD at Oklahoma State. I'm in the dissertation phase and focusing on some behavioral finance stuff there. But then finally, as part of the academic stuff, I'm the clinical professor of finance at Loyola Chicago. Because of the current world situation, I've taken on a full load in the fall, and I'm teaching corporate finance, investments. I'm teaching undergraduate derivatives, which is a new class I created there. And then I'm also teaching financial ethics. So yeah, lots of hats, and the fall is going to be a busy few months for me for sure.
Are you finding that colleges are talking more and more now about derivatives?
Yeah, I most definitely, and that was a trend that was catching on more in the time that I spent at SIBO. One of the fun things about that job, and one of the fun things about what I get to do now, is dealing with college students. They haven't been jaded by the markets quite yet. They're much more enthusiastic. It's sometimes, when you're explaining what goes on in the financial markets to college kids, I equate it to one of my favorite students that my kids had in grade school. Their first grade teacher said she liked teaching first grade because she was teaching them how to read, and she liked watching that light bulb go off. I enjoy talking to the college kids as well for the same reason. And sometimes on my own dime, when I was at SIBO, I would go out and visit schools and go talk to the finance club, and that group of people. First off, they're really they're really bright, and the handful that are really enthusiastic and focused, they're coming after us. So, and they're teaching them more in the university level now, so they're coming in a little bit more prepared than maybe you or I did when we got into the industry.
Yeah, well, that's obviously really good to hear. And how did you get started on this? Take us back to the beginning.
Sure.
Yeah.
Well, I grew up down in Memphis, and there were and went to University of Memphis. It was even Memphis State. It was so long ago. Finishing undergrad, I knew a couple of people that had come up here and done the typical worked their way up from being a runner type of thing. I think every other person in our industry at one time or another, at least in my age group, worked for one of a handful of big firms that needed a lot of operational help on the trading floors. I started out being a runner in the meat pits, caught the eye of a couple of people, and finished up on the floor working in the Eurodollar option pit, which at the time, it's the one that if you wanted really cool news footage, that's the one that you showed, because they claimed there were 1,100 people in that pit, which I don't even think there's 1,100 people on a floor now. But I realized the lack of intellectual stimulation that you get being in the pit all day just really wasn't for me. There's a lot of waiting around, and everybody that's even visited the trading floor knows there's a lot of waiting around. So I started, I wanted to look at things from a more analytical point of view. While I was on the CME floor, they introduced Globex. So I do think that the introduction of electronic trading was something that helped me tremendously. If I'd been 10 years older, I don't know what I would be doing industry-wise, because I didn't like trading on the floor. Actually, I liked the camaraderie, but I didn't necessarily like trading down there. So I got more into systematic approaches, and as electronic trading, surpassed pit trading, I think it lent itself more toward the kind of work that I like to do.
That's funny. I was actually in the Eurodollar options when they launched Globex too. I was in there in 1996. And then I ended up going to the S&P in 97, and then within a couple of years I ended up becoming a member, and for me it's the same way. I just wasn't a good pit trader. That's the reason I didn't like standing in there, but I became one of the first people trading the E-Mini S&P when that was launched. So that's pretty interesting. We've got that in common.
Oh, nice.
And so I want to talk a little bit about your process for trading. I mean, I know because I've spoken with you in the past, and obviously you put a lot of content out. I read a lot about how you actually talk a lot about the VIX, but you also talk a lot about spread trading, like the Russell versus the S&P or the NASDAQ. And that's something I think this year specifically, I've seen more and more traders talking about spreading between the markets. I mean, just look at the NASDAQ, the way it's been so different. I mean, versus the S&P and the Russell, they all have the charts look similar, but they do look different in a lot of ways in the way they've been acting. So I know a lot of my friends have been trading that way this year. So talk to us a bit about that process and how you go about spreading the indices.
Sure. I basically, like you said, they all kind of move in the same direction. We do get some ridiculous divergences every once in a while. The biggest divergence that before this year, the biggest divergence that I can remember with respect to the Russell versus the S&P, which is really the two that I like to pair up with each other, was after Trump was elected. I think you had an outperformance of the Russell 2000 by about 10% or so relative to the S&P 500, and then over time they both came back in line with each other. It's been opposite lately, where the Russell 2000 has been the underperformer. What's been going on in the world, I think, is perceived as a negative for smaller companies, maybe for companies that don't have as much sway with being declared essential and getting to open during all of this. But for whatever the reason, we've had that S&P outperformance versus the Russell 2000. Now, the first thing that really caught my eye about trading the two against each other was what happened back in 2016. But before that, I had done a lot of pair trading individual stocks versus each other, and had tried to apply it to the relevant ETFs, and never really found much there. I think the environment changed enough, and maybe more people are trading ETFs, which in turn will impact the various index performance. But there's been more opportunities to trade the two against each other. And what I think kind of solidified it for me is the micro futures that came out this year. I would trade the slightly bigger mini futures versus each other, but now with the micros, I think it gives you a chance to reweight yourself periodically. If you want to be right now, I'm long the Russell, I'm short the S&P 500. I've been in and out of that position a couple of times over the last couple of months. With the micros, you get just so much more flexibility with how you're sizing things up and sizing things down, that you can go from being, let's say, equity market neutral, but long Russell, short the S&P, to slightly short or slightly long the overall market based on what your feeling is right now. So I think that combined, that there's been more of a divergence between the two. I don't know if it's because there's an increased awareness that there's so much fundamental difference between the S&P 500 and the Russell 2000. And then there's a relatively new, very liquid product that allows us to trade the two versus each other.
So I definitely understand your reasoning for the spread. I want to talk a little bit more about how a trade develops. What's the ratio between the two? So you said that right now you're long the Russell and short the S&P. Take us back to before you got into that position and walk us through that process for you wanting to get in and how you're managing it.
Okay, well, going back, and I'm doing this off the top of my head, so if I misquote or misidentify a couple of dates, and I'm happy to be fact checked, and I'll go back and check for the specifics. But as this situation developed, you did see a ridiculous divergence between or among the NASDAQ, which we're all aware of. Just because some of the larger NASDAQ companies have fundamentally benefited from what is 2020. But I started to see that the S&P and the Russell were going in opposite directions. I recalled just from history, and I think one of the things that makes us older guys a little bit better than the younger guys at trading is we do have some history to rely upon. I know that the two generally don't diverge by more than 10%. And that's just outperformance one versus the other. I think we reached that point in mid to late June, and that's when I started easing into the position. Initially, I didn't really want to pick a direction with the overall stock market, really because the attitude about the COVID situation and whether we're going to get through it or not has been very fluid. If we get announcement out of Russia, which came a little bit later, that they've got a vaccine, and everybody likes that, and both equity markets rush up tremendously to get the Russell actually outperforms a little bit. But I really haven't felt terribly comfortable because I don't feel like I have a really good feel for why stocks are doing what they're doing. So typically I would do long two Russell futures versus short one S&P future, which with the that's pretty close to market neutral. The quoted value of the Russell 2000 is about half that of the S&P 500 right now. If I start to feel like we're topping out, I'm actually a little bit more comfortable with being more short S&P futures than long Russell futures, because it does seem like when we get the moves to the downside, that's really where you're seeing the Russell underperformance. So when I'm getting overweighted short or more short than long in this current environment, it really does involve being more short S&P futures than adding to the long side on the Russell 2000 futures. There was one instance where I think over just 2 or 3 days, we got about 3% outperformance of the Russell versus the S&P 500. And at that point, I actually got flat for a couple of days. And then the spread between the two widened back out, and then I got back in a neutral position. And as of late August, that's where I was. I was basically, we always tend to see the equity market run up a little bit into the end of a month. And so I decided to stay, net neutral through the end of the month. I assume I'll be taking advantage of the volatility around the difference between the two periodically throughout September and October. I'm not sure what I'm going to do as the election approaches, because I think a Trump victory is probably better for the Russell than the S&P 500. I'm not really sure if a Biden victory is better for multinational companies or not, or if that's already priced in. So I've really, I'm going to keep a close eye on it starting mid-October with respect to election news, polling news, and how that relationship is working out.
So a couple things I'm taking away from this. Number one is, the obvious thing is, what I like about spreading is that really it allows you to stay in a position longer. I mean, as a trader, I'm always trying to hold the position that I feel I have the strongest hand in as long as I possibly can, right? And this being in a spread position where you're long one, short the other, and a markets that are, like we said, they're typically correlated, it allows you to hold that trade for a longer duration. The other thing is you're doing 2-to-1 Russell to S&P, and you're not doing it very systematic or technical. It's more about percentage that it's getting away from the Russell. Is that what you're saying? So the S&P is outperforming by X amount, and then you're like, okay, at this point, it's almost like catch up, right? The S&P is probably going to be more volatile, and the Russell will be less volatile and maybe start to grind higher. I'm just guessing that's what you're thinking.
I'm thinking that I don't know if I'm going to make money off of being short the S&P 500 or being long the Russell 2000. I definitely don't look at them separately. This is one position, and that. And it makes it easier for me to manage. I'm the first person in the world that will tell you what I'm not very good at, and typically not having a pure systematic approach to something that I'm doing is something that I've not done very well with in the past. In fact, the best that I've done trading futures has involved back testing and being and paying attention to the to the rules and following the rules and knowing that the rules are smarter than I am. But this is a situation where it's a couple of markets that I've watched very closely over a long period of time. I've successfully done this in other markets with a little bit of discretion. And the beginning of this trade, as I watched the relationship between the two developed, it really was, I wasn't going to do anything trigger-wise until I saw a 10% outperformance of the S&P 500 versus the Russell, because that's as wide as it had ever gotten. And I know that we have surpassed that, but the beginning of the trade, I was itching to do it earlier, and I had one of those great conversations with myself where I said, "Self, you know that it can get as wide as 10%. Wait till it gets there, and then maybe start trading around it."
Traders, we're going to pause for 30 seconds, and we'll be right back. A question I constantly get is, what platform do I use to trade futures? Well, I use TT. They are the world's fastest commercially available futures trading platform. Learn more at tryttnow.com. RJO is a long-standing brokerage firm with personal broker relationships to help you learn and trade futures. To learn more, please visit rjofutures.com. I think that a lot more newer traders really should be looking into this style, I think, because just as I said, it gives you the ability to stay in a position longer. I'm an outright guy. I always have been. And even right now, as we are recording this, I'm long the Russell, and I don't have anything against it. So I'm really just kind of held by that, good till canceled stop. But if you have that little bit of a hedge on, it allows you, and you being a professor, I think it's a teaching moment when you could be in a position longer. I think that you have that connection with the market to where you're learning more about both markets.
Yeah, it's making me, and that's another thing, especially with the micro futures. I'm going to backtrack just a slight bit. One thing that I have no belief in whatsoever is paper trading. When I was teaching at SIBO, I would always say, do a very small trade. That way, you're going to get a feel for how, for option traders, about how option prices behave. This is a situation where, sized it up to the point where I could be doing the same thing with, with the regular size mini futures contracts, but it allows me to be very small in the position, force me to watch the relationship between the two and not really be risking a whole lot of money. And
Exactly.
that's what, when they first announced that the micros were coming out, I felt like that was a really good use of the micros for beginner traders, is get a feel for, how these futures markets behave, because they're going to move right in line with their. It's kind of silly using the word mini for the bigger contract, but that's what they are. But
Yep.
with the mini futures contracts. And then, you mentioned I'm a professor. I can't watch the market about 12 hours a week. So that's one of the reasons I like to do things that are extremely rules based. And before the COVID thing, I was on a plane at least once every other week. And I like being able to do trades that that I don't have to worry about when I can't, when I can't be watching the markets. And this is one of those trades that I'm really not overly concerned. I don't really think that we're going to wake up one morning and the S&P is going to be outperforming the Russell 2000 by 10%.
Yeah.
Whereas something catastrophic could happen in the world, and either the long side of that trade could be in an awful lot of trouble, but it's going to be offset by the short side of the trade. Some of the other things that I've done discretionary wise, looking at different oil contracts versus each other, looking at different grains versus each other, and definitely calendar spread trading some of the volatility futures as well. And that's anything that I do that has discretion involves some sort of spread like this, where I'm not going to get blown up by some outlier event that I don't see coming.
Yeah, no, exactly. And that's why I think that I wish really more new traders would look at spreading. And it almost sounds, when you hear the word spread, it's as though it's more complicated. But in this instance, it's actually it's very simple, right? I mean, you find the ratio, right? You find the ratio, you find the markets that are highly correlated with each other. You put a simple rule, let's call it, that you put in and said, if they perform by X amount, then I step in and this is my spread. And I just going to keep going back to, when you're spreading the indices, it allows you to be in the market and really build the relationship with both market, because you have skin in the game. You're watching how it's moving and you're learning something.
Yeah, you don't learn anything. When I used to do the big ballroom, things on Saturday mornings for SIBO, I'd start out with, and I was teaching some basic strategies. I would say, who here is paper traded? Get a bunch of hands. And I go, okay, who's paper traded and lost track of what they were paper trading? And get a little chuckle and a lot of people admitting that they had done that. It's just not the same. I mentioned my dissertation. My dissertation is all about behavioral finance. And there's a big difference between writing something down and monitoring it, even if it's an idea that you thought would work out, and doing the exact same thing. And even if you only lose $50, losing $50, plus you're gonna pay more attention to it. You're not gonna forget to check in and write something in your notebook because your broker is doing that for you with a brokerage statement.
So let's talk about a little bit. I want to talk a little bit more about how you're spreading the indices. And so we talked about 2-to-1 with the Russell. You have that rule: if the S&P gets X percentage above the Russell in outperformance, then that's a trigger for you to get in. Now let's talk about something that I talk about a lot on the outright side: is before I get in, know where I'm wrong, and also how does this trade? How do you get out of this trade as a winner? So talk to us about where you would cover if you were wrong, and then how you would look to start to cover this trade on the winning side.
I probably would, if the trend continues and we end up with a situation that's never occurred in the past, and this will probably be the worst time to get out of it. But if let's say we hit the election, Biden gets elected, And the first day after Biden gets elected, everybody thinks we're going back to globalism or whatever, and I don't want to hear anything about the politics. I'm just throwing a hypothetical out there. And the day after he's elected, the S&P outperforms the Russell 2000 by 2%. I'm probably going to walk away from that trade for a while. Because I think that would be an indication of what everybody believes is going to happen, and not much is going to happen between Election Day and Inauguration Day to change people's minds. So you'll probably see some sort of trend that matches up with the belief of either the change in the political climate or how things are going to stay the same if Trump happens to get elected. That probably would be the catalyst that got me out of trading this. If I can get the Russell to outperform the S&P 500 maybe by about half of that 10%, maybe 5% or so, I'd probably walk away from it as well and see if they widen back out to get back into it. But and I'm sitting here talking to you, and I'm sitting here thinking I should write some of this down, because I really have just been probably more discretionary with this trade than I have been with anything that I've done in a very long time. And it really just is watching the relationship between the two for several years now. And that's just because they were the two main things that were trading at one of my old employers. So, but that really, I think that's what would make me acknowledge I'm wrong. What's funny is I haven't given as much consideration to being wrong with this one as I would something that has more of a thesis behind it and is more directional and doesn't have that built-in cushion. But I probably, again, as I spout on here, I'm actually thinking I probably should come up with maybe a quantitative area that I need to be second guessing myself.
Well, this is where I think where a lot of outright traders that have been doing this for a good period of time, they could start either scaling into some of these positions, scaling out, using their technicals and using different skills that they have around this position. But going back to spreading the indices the way that you are, it's just that you ultimately just have a strong hand in the market, because if something bad or really good happens and the market moves, most likely on that news, they're both going to move together. So if you're ratioed right, your win or loss should be minimal, obviously, compared to being in an outright. And going back to where you were wrong, you're really waiting for a headline to potentially set a new trend. Right? I mean, similar to what like COVID did. COVID set an initial trend. I mean, look at the NASDAQ outperforming everybody else, and you just know that, okay, the market told you that as that was happening. That's the one you don't want to be short. So because it's probably going to hurt you the most being short it.
Yeah.
And so it makes sense. And I want to go back to I talked about how you write a lot about the VIX. And I don't know if this ties in to what you're doing with spreading the indices, but you do talk a lot about the VIX. Talk to us about how you trade that, and if at all you use that, as a tool to help you spreading the indices.
I actually do use it as a tool, and I'm gonna answer that part first with respect to the individual indices. We've got VIX for the S&P 500, but we've also got a Russell 2000 VIX. And the relationship between those two tells you an awful lot. Typically, when there's a lot of macro concern, the spread between the two narrows an awful lot. When there's a lot more concern about the U.S. versus the rest of the world, the spread widens. And when I say widens and narrows, I mean VIX subtracted from the Russell 2000 volatility index. There have only been a handful of days over history that VIX has actually been at a premium relative to the Russell 2000, and those are always associated with global macro situations. Initially, that's what we saw in this situation, but now it's reversed itself to a point where the Russell 2000 volatility index is at as wide a premium relative to VIX as we've seen, which means that the concerns for the U.S. are much higher than global investment concerns. And I think of the VIX as almost a global volatility index because if you think of the S&P 500 as one big company, the majority of their revenues come from outside the U.S. If you think of the Russell 2000 as a one big company, the majority of their sales come from within the U.S. Now, some people argue against that, saying, yeah, Russell 2000 companies produce stuff, but very often they're selling it to companies that eventually sell things internationally. But I like my thought of the Russell 2000 being, USA stock and the S&P 500 being global stock, and using the relationship between those two volatility indexes gives you an idea of how concerned people are about one or the other. Right. And typically that relationship reverts back to a normal level. That's been a secondary thing that I've kept an eye on with respect to the spread that we've been talking about. Now, I've got a long history with VIX. I wrote a book on VIX when I was at SIBO almost 10 years ago. I've got, here's shameless plug, I got another one coming out in a couple of months. It's been a heck of a year to try to write a book on VIX because things keep changing an awful lot. The way that I use VIX when looking just at the S&P 500 is as a confirming indicator. And Larry McMillan, who wrote, an option book that we all, that anybody in the industry probably has at least one version of. He really is the one that came up with this way of looking at things. But typically, when the S&P 500 and VIX are both trending higher at the same time, and that is actually something we've been experiencing in August,
Yep.
it does not end well for the stock market. The last time we really saw this sort of relationship was over the course of January in 2018, and we know what happened in early February. We had a volatility event, and when VIX is trending higher, really what you need to think of with respect to VIX trending higher, without even looking at the S&P 500, it's an indication of how much demand there is out there for stock portfolio protection and how much people are paying up for it. And when people continue to pay up for S&P 500 put options, even as the S&P 500 is making new highs, eventually these are smart people that are putting money to work. And if they've got concern, we may need to be having concern as well. You can see that on a daily chart. You can see that on a 1-minute chart, where there will be days that the S&P 500 is maybe making a new intraday high, but VIX has stopped making an intraday low, that it's kind of starting to tick up before, and then the S&P 500 maybe starts to work its way lower after that. But using VIX as a confirming indicator relative to the S&P 500, I always say, even if you don't understand what VIX is, if you never have any intent whatsoever on trading VIX, but you do trade, S&P futures or the S&P 500 in any way, shape, or form, you should have VIX next to it on your screen.
Yeah, that's me. I mean, I look at the VIX and I don't really know the past relationships when it's going up with the S&P. I mean, I watch it loosely. I don't watch it obviously like the way that you do. And hearing you mention that when the VIX is going up with the S&P, that it typically ends badly. I guess my thinking is the historical evidence of that is that the VIX is actually the leader. So the VIX, what you're saying is the VIX is the one that's right.
If VIX is, if VIX is showing that professional, okay, VIX is calculated using both puts and calls on the S&P 500. But when it comes down to it, there's a lot more put activity than call activity on the S&P 500 each day. So it really is demand for puts that more often than not drives VIX. So if you are seeing if the pit, which is open but scattered at the SIBO right now, is seeing more demand come into the pit for SPX options, and it's most likely puts, that's going to push the implied volatility of those options higher, and that's going to result in a higher VIX, which, if again, when the S&P 500 is moving up, but you've got people buying portfolio protection, they see something on the horizon. There and the majority of SPX option activity is institutional. I know that there are some smaller traders that use those options. Retail tends to look at the SPY ETF options. And so, it really is the index options that are being driven by institutions. The other thing that you get to look at with respect to VIX is the front month future, and where is it relative to spot VIX. I say you should at minimum have VIX on your screen. You probably should have the front 2-month futures up there as well, because there's not a fair value relationship between spot VIX and the VIX futures contract. The VIX futures pricing really is based on an anticipation as to the direction of VIX until we're at settlement, plus some sort of a risk premium. There's always a risk premium if you're short volatility. So in a normal environment, you would expect the near month VIX future to be at 1 or 2 point premium relative to spot VIX. If spot VIX is moving down, but the future is holding up, that's something that should be catching your eye as well. And I actually, a long time ago, and I update it periodically because the number of days left to expiration get in there and kind of mess around with trying to analyze the relationship. I actually try to time weight the front 2-month VIX futures and have a future that has a consistent 30-day outlook and compare that to spot VIX. And I found that to be a very, very useful indicator where you get an idea of how skittish are people at selling VIX futures right now, because the most common use of VIX futures contracts or volatility derivatives is to try to capture the volatility risk premia. And when that's a strategy that you can get run over with. If you're concerned about getting run over, you're not going to be as aggressively, either shorting VIX futures or putting on other types of strategies that, take advantage of the consistent overpricing of volatility relative to realized volatility.
I was going to ask you about VIX futures as well, and so you're basically saying, and I don't watch the futures; I only watch the VIX spot. So the front 2 months of VIX, is VIX expire monthly?
It does, and it's a Wednesday. It expires on a Wednesday, and it expires on it. Sometimes it's the 3rd week Wednesday, and sometimes it's the 4th week Wednesday. You definitely need a trading calendar to keep up with it. The date is determined by the following month's 3rd Friday, because that's the standard option expiration date.
Okay,
and the VIX settlement price, which is an Wednesday AM settled product, it is based on the options that expire 30 days in the future. So if you add 30 days to a Wednesday, you're going to get a Friday in the following month, and it should be the 3rd Friday because those are the standard SPX option contracts. But they are monthly. They are monthly futures.
I want to go back to when the S&P is going up with the VIX. And how you said historically that's not been well for the stock market. And hearing you talk today, and I've known this, but it's just reinforcing kind of what I knew, but wasn't exactly sure that I knew the right thing, that the puts are really what's more of driving the VIX, correct? Okay,
yeah,
so the question I have about that is that, okay, if people are more active in the puts, I'm thinking to myself, if I'm long a bunch of futures, of course I'm going to be more active in the puts. I mean, I don't know. I'm not an options trader. Would I be more active in the calls? So you have all-time highs happening here. We're breaking out again. Nobody truly believes this in their gut that this is what should be happening, but it is what's happening. So my mind as a trader goes to, well, if I'm long a bunch of S&P, of course I'd be buying some puts against it. I mean, this is not my style of trading, so I'm not saying that I know that this is what would be driving the VIX up. But my thinking is, I feel because there's so much uncertainty that's why the puts are going up. And going back to my own thinking as a trader, the uncertainty to me a lot of times is what drives these rallies further. So I'm just curious what you think about that.
Yeah, you've got to, one of the things with respect to the equity index market versus all the other futures markets is, in reality, the S&P, the majority of people out there are long the S&P 500. Now, that's not, in the futures market, there's one long for every short and all that kind of stuff. But, in reality, the majority of money managers are long stocks. So, it's not necessarily the futures traders that are jumping in for portfolio protection. It's more of institutional managers that either want to lock in some performance or are willing to give up 0.5% or so and buy some out of the money SPX puts. It's really just, it's a volume thing. On average, over the long term, 175 SPX puts trade for every 100 calls. The typical put to call ratio is 1.75 to 1, and that's the only market. The broad-based index option market is the only market where you consistently see more put activity than call activity. If you look at individual stock options, it's more about calls. In commodities, it varies depending on, if we're having a run in oil to the upside, you might see more call activity. If you see a big drop in the price of oil, suddenly it actually moves over to the put side. But that in that broad-based index thing, that 175 to 1 thing, that Eurostoxx 50, the Nikkei, any market that has any broad-based index market that has more, that has options available, typically have more put than call activity. The ones that don't that have a little bit less is Australia and Canada. And the reason for I'm not going to put you on the spot and make you guess why. I'm just going to tell you. They're both so natural resource oriented that their option activity is kind of a blend between energy markets and equity markets. But in general, most pure equity markets that are diverse economies really do see a lot more put activity than call activity. And it's because the most common use of index options is for portfolio insurance. And you just look at VIX as, as a gauge of how much are people paying for insurance, or are they not paying for it at all right now?
Yeah. No, it was definitely learned a lot from hearing you talk about that, because like I said, I'm just a casual VIX watcher.
Yeah.
And I've never even pulled up the futures. I didn't know too much about it. It's just one of those things is, for me, it doesn't fit too much into my strategy, into my thinking. Mm-hmm. But knowing those things, I think, is very helpful, because I could tell you what, on a personal level, I have been doing more swing positioning this year, swing trading. So I have been considering doing some spreading, just because I just think that this year, going back to what I said earlier, is a year where there's a lot of opportunity for spreading. I mean, like right now, I talked about how I'm long the Russell. It's like if I start to see the S&P start to get in areas where maybe it does start to show some weakness, combined with what you were talking about with what you were seeing in the month of August with the VIX, it's like that's where the micros could be a great little hedge for me intraday to kind of hold on to my Russell position if things are going down. It's just adding things to our arsenal as traders. But Russell, we could go on, and you and I, talk about all this stuff, but I've got some rapid fire questions next, if you are ready for those.
I am ready for the rapid fire questions. So,
all right, everybody. Our rapid fire questions are sponsored by Trading Technologies. You can trade TT anywhere in the world. They are the fastest commercially available futures trading platform, now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. Learn more at tryttnow.com. Russell, first question for you: what trader has influenced your career the most, and why?
I was thinking about this one, and I actually am going to give you a little bit of a surprise answer. Raggy Horner. I have always thought the world of her. I've never met her. I've never spoken to her. I own all her books, and you just had her on the other day.
Yep.
And I haven't done as much in currencies as I had in the past. So it didn't immediately come to mind, but then I saw, I listened to the podcast you did with her, and she actually, again, and I've never even had a chance to speak to her, but we've just never, I cross paths with everybody, but I don't know how I never crossed paths with her. But that's one. I really wanted to get very systematic in the things that I did. So, the whole story of the turtles and the turtle approach, some of the things that I initially did quantitatively that I translated into rules-based trading directly came from their approach, where you're buying new highs or selling new lows. In fact, one of the things that I try to teach my students at Loyola is sometimes you're better off buying high to sell higher, or shorting low to cover lower. So that approach and realize and knowing that people have had some real success, following what I just said, gives me confidence when I'm trying to trade a breakout system.
What was one of the hardest things for you to overcome in trading?
What I just said, buying new highs. No, really, it's writing up a trading system, seeing how well it's worked in the past, trading it small, and then starting to size into it. When I've got right now, it would be very difficult for me to, if I had a signal telling me to buy one of the stock index futures outright, it'd be pretty tough to follow that because the market doesn't make sense to me right now.
How has your trading process evolved over the years?
Definitely incorporating options into what I do is one of the things, and that that came about by starting to work at the Options Institute at SIBO, and then working with CME Group on all of their different option offerings. But one of the nice things about putting options into the process is you don't necessarily, you're able to put on positions with defined outcomes and not necessarily get stopped out of a position. And we've been talking about the micros. They're going to start. They started offering options on a couple of the micro futures at CME Group, which is going to open up some more opportunities for me to play around with some things.
What is one attribute that you believe every trader should have?
Risk management, starting out really small. One of my wife's friends has taken a look at the option market, and by default, she asked my wife for some advice, and my wife said, just start out. Don't risk everything. Start out really small. So proper risk management, but you can't win the game if you blow yourself out of the game.
Favorite book about trading?
I love all the Market Wizard books, and I actually have them all on CDs still. And I just like to hear other people's successes, because I think when you hear that, especially people from all different walks of life that have been able to make a living at trading, it gives you, I think it's kind of encouraging. We can watch Last Dance. We're never going to be Michael Jordan. We can be some of the people in Market Wizards if we work hard enough.
What's the best piece of advice you received about trading?
I never really got good direct advice. I really felt like I'm extremely self-taught. When you're trying to come up with the secret sauce and your own proprietary system, and there are other people that are trading the same way, they're all very secretive. So, the approach that I developed with the futures markets, it really ended up being more self-taught than anything else.
If you could go back in time and give the younger you a piece of advice about trading, what would it be?
Russell, you are going to be the worst discretionary trader ever. I would save myself the tuition behind that one. So,
if you had to pick a profession other than trading, what would it be?
Mm-hmm. Outside of trading, probably just full-time academic. I really enjoy being at Loyola, and I enjoy the students there an awful lot as well. So I probably would go back to being a full-time academic and be one of those that writes a lot of practitioner-oriented research.
If you had an elevator pitch me your edge in trading, what would you say?
I've got a systematic approach that combines both breakouts and mean reversion with financial futures, which has consistently worked in flat, down, and up market environments.
Last question for today, Russell. Favorite thing to do when you're not trading?
I like to escape from the house full of women that I live with by riding my bike.
Nice.
I have a wife, 2 daughters, and 3 female dogs, and I have been totally outnumbered during the COVID situation. Thank goodness that it wasn't like from November to March, because I would have been stuck.
Russell, where can people find you on Twitter? Give us a website to check out, and also tell us when the book is coming out and where people can buy it.
So Twitter, it's just at Russell Rhoads. It's a little bit different spelling, Rhoads. A good portion of what I do, anything that I write about systematic trading actually shows up at EQ Derivatives, and it's in front of the paywall. So you get eqderivatives.com. Most of what we do is behind the paywall. A good portion of what I do is in front of the paywall. So don't get initially discouraged. Search around for me a little bit, and you should be able to read some of what I'm doing. Right now, the book is scheduled for October 27th, and it's the VIX Trader's Handbook, and it's sitting out there on Amazon for pre-sale already.
Well, I got to tell you, Russell, I learned a lot today from you about the VIX. I learned a lot about your process for spreading the indices. Really, just overall, just a great conversation. Like I said, learned a ton, and I'm so thankful for you taking the time on the weekend to chat with me here on Futures Radio Show.
You bet. Thanks a lot for having me.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.